Welcome, Brandon and Xiaolin. Extremely happy to have you here to talk about my favorite topic at the moment, China. I'm deeply involved now, but I haven't spoken to one of the fund managers, so I'm very happy that we can also talk about product today. But first of all, KraneShares, can you give me an introduction?
Sure, no, thanks. Great to see you, Jean-Paul, and thank you for the opportunity. If we look at our introduction slide, you'll see our founder, Jonathan Crane, who was is an American who went to China in the early 2000s, and he built a business geared to China's growing urban middle class. And what John experienced living in Shanghai was that China's economy was changing, that we think about China as a export-driven manufacturing economy, but the reality is China's economy is evolving. And this really started in the early 2000s. And so John saw that China was becoming a consumption-driven economy, and he built a very successful business in China. Ultimately sold that business. Now, on the next slide, Jean-Paul, he comes back to New York and can't believe how much the exchange-traded funds industry's grown. But when he looked at China exposure within broader benchmarks like, say, emerging markets and China-specific ETFs, they were all geared to China's old economy. And what John saw living in China was this movement to new economic sectors. And those new economic sectors would be domestic consumption driven by internet and e-commerce companies. He saw a growing urban middle class using more healthcare. The rise of clean energy and electric vehicles. We had the adoption of technology like 5G and semiconductors. And that really led to John starting down the path of creating KraneShares, a China-focused provider of exchange-traded funds.
And when was that, Brandon? In which year are we talking about?
So he got back. So he went to China in the early 2000s, comes back like a decade later, spends 2 years studying the ETF industry.
Oh, wow.
I got introduced to John in around 2012. I had worked for Barclays Global Investors, and then I worked for BlackRock, always in their iShares ETF business. And when John talked about his vision, I just thought about it from a index investor perspective, which is you have the adoption of ETFs and index funds. And John talked about how you had the second largest stock market in the world wasn't in any index, the Shanghai and Shenzhen. So I just thought about if you have this market that John was saying was opening up, allowing more foreign investors, that to me, I just wanted to be part of owning what other people were going to have to buy. So I quit my job to help make John's vision investable. And we've been very fortunate to as the firm's grown. Xiaolin joined from JP Morgan within their private bank. We've really brought on very seasoned, experienced investment professionals who kind of, like I think John originally saw this great opportunity. And, we've really, I think over the last, call it almost, 7.5, 8 years, starting a company from zero, no clients, no brand, no assets.
But I like it. In the meantime, you even made it to Amsterdam, I see in the upper right corner, because that's the Euronext introduction. Very nice, very nice. But KraneShares also is related to CICC. China International Capital Corporation. How does that cooperation work?
Well, so originally, John started the firm on his himself, funded the firm, and due diligence people, kind of like yourself, Jean Paul, or a lot of due diligence people, they didn't like that we weren't part of a bigger entity, and that is what happened if there was a market downturn. Could could the firm survive that? And so a lot of prospective investors said, if you're part of something bigger, we actually like that. If you were part of a big asset manager, a big hedge fund or private equity, it would give them comfort that the business was sustainable through different market cycles. And ultimately, we were a research partner. We got research from CICC. CICC was co-founded by Morgan Stanley in the mid-1990s. They're the largest investment bank in China. They're the largest private equity firm in China. They have about $400 billion of client wealth assets. But more importantly, they've won Institutional Investors All China Research Survey 9 years in a row. Wow. And that's ahead of UBS and JP Morgan and Goldman Sachs. And what we got their CICC research, and they said, next time you go to Beijing, the way that you think, John's vision around new China and the opening up of China was very aligned with how CICC thinks about the China market themselves. That, like John saw living in China, you want to be aligned with their 5-year plan, their economic blueprint, because that economic game plan drives a lot of flows. And John saw that living in China. CICC always believes that you want to be invested with where this government policy is going. And so John, when he went to Beijing, met the CEO. A lot of these were ex-Morgan Stanley people, from decades later. And so they actually took it in, they bought, half of the firm, 50.1%. And I think it's just been a fantastic partnership. It's allowed, Xiaolin, runs the European business, and they've given her the, basically the money to build out our European franchise, our UCITS business. But we've also listed in Hong Kong now. So it's just been a fantastic partnership.
Oh, excellent.
Certainly, delivering that research goes a long way.
Yeah. Good.
So
what do we see?
I think a key part is element is we know China is big. It's a big country geographically. It's a big population, and it's a big economy. The second largest in the world, and I think every investor needs to understand what's happening in China. And I think ultimately, for Xiaolin and myself and the rest of our team, what we really want to bring is a balanced perspective to what's happening in China. That sometimes we see headlines, and we just want to provide a balanced perspective. We want to earn that. We want to earn that by providing this good research. So from day one, we've always been focused on quality research on China, and again, I think what's impressive is that China's already big, but as we look at the next slide, it's still growing. In 2020, China will be the only major economic country to have positive GDP growth, about 2%, just over 2% this year. The estimates for 8% next year. But what's really interesting is how China is going to continue to grow in the future. That China, we ultimately believe the trend of urbanization has created this urban middle class. And the Brookings Institute recently said that China's urban middle class spends about $7 trillion annually. That's more than the $4 trillion of the US middle class. And what's interesting is only about 60% of China's population currently lives in cities. And that's going to grow to probably around 75% where South Korea and Japan are, which means hundreds of millions of more people are going to be moving into these cities. Yeah. And this urban middle class is only going to keep growing. Now, on the next slide.
Is it, if I may, because I read in the South China Morning Post this week that the president, Xi Jinping, is talking about becoming a high-income country by 2025. But, high income in this chart is still very small. So will the pace be that fast to get there?
Well, they've said that they want to double the economy by 2035. They want to be carbon neutral by 2050. And I think this goes back to, China, they're drafting the 14th five-year plan, this economic blueprint. And I think, when, there's a lot of transparency on what they're going to do. And, when they say they're gonna do it, they're gonna do it. There's
nothing holding them back.
Yeah, there's no bipartisan bickering. Now what I find kind of fascinating, from a passive investor's perspective, we talk about how large China is, but then look at the size of China. That institutions globally use MSCI's all-country world benchmark as the benchmark. It's their definition of global equities, the global stock market. Now, China has a GDP that's twice as large as Japan, but it's almost half the size of Japan from a percentage of the portfolio. You can see how massive the United States is, almost 60% of the benchmark. And if the benchmark, if it wasn't, say, market cap weighted, if it was GDP weighted, China would be 3 times the size, right? So China's been underinvested. And part of the reason for this underinvestment, Jean-Paul, if we look at the next slide, is because of the definition of China. So this is almost what led me to quit my job to be part of joining KraneShares was as the world's adopted passive investing, we don't really think about how these index methodologies determine what we own. And this is MSCI's definition of emerging markets. Now, the definition of China within this benchmark, 10 years ago, China was 17% of this benchmark. Today, it's over 40%. Numerically, China was only about 137 stocks. Today, it's well over 700. So what's happening is China, this Shanghai Shenzhen market, has allowed foreign investors to come in. And that's allowed MSCI, which historically the definition of China was Chinese companies listed in Hong Kong. That was only like 100 stocks. Shanghai Shenzhen, you have hundreds of stocks. So MSCI is slowly adding these Shanghai and Shenzhen, these Chinese A shares, and MSCI is adding their specific definition of A shares with this orange slice, which is really large cap and mid cap Shanghai and Shenzhen names. And so right now those make up less than 5% of the weight because they're just adding pieces of their market cap. So they've added 20% of the potential weight. Now we can see if they fully included these Chinese A shares, those Chinese A shares on their own are 20% of the benchmark. So China's at just over 40% of the benchmark right now, but you can see it would be 50% with this inclusion. Yeah. So there's a lot more China coming.
Yeah, so just that we get it straight. Yeah, the A shares, I understand that is, let's say, the orange part, but yes, if you wish, the purple part, those are the H shares, the Hong Kong listed shares that were already there, and the A shares will be added on top.
Yes.
Yeah.
Correct.
Okay.
Yep. And it's the kind of purplish color, the China also includes the U.S. listed names.
That's included as well.
Yes.
Okay.
But prior to 2018's inclusion, Jean-Paul, you probably know this just for the benefit of for the audiences. Prior 2018's inclusion is zero allocations to China A shares. The orange bar was almost nothing, and then that is the true economic engine in China that is completely no allocation in global investors benchmark at all, right? And now since inclusion, you start to get access to those.
Yeah.
So, I mentioned on the next slide, Jean-Paul, that MSCI is using a very specific definition of Shanghai and Shenzhen names. That MSCI, to me, is arguably the most important company in finance today, because their global investable market index methodology dictates almost $15 trillion worth of both active and passive assets. That on the passive side, this is what big asset, ETF providers and index fund managers, they have to do what MSCI tells them to do. Active managers have to at least understand MSCI's definition. And so there are other definitions of Chinese A shares, but we've always been we always want to be aligned with MSCI's definition. And that's why on the next page, we listed, in the US, we listed our first Chinese A share ETF back in March of 2014. We were actually the first MSCI China A ETF globally with our KBA US. But then in June of last year, Xiaolin led our team's effort to bring this very specific definition of Chinese A shares to Europe via a UCITS package. So KBA UCITS is our very specific definition of Chinese A shares from MSCI.
Yep.
This
was your first ETF, right?
Yes, it's an ETF.
Yeah, the first one. Yeah.
Yep. The US was the first MSCI China A. And again, there's other definition of Chinese A shares, but we want to own what other asset managers are going to have to buy.
Sure.
And that's really MSCI's definition. I think it's a key differentiator for us.
How many assets do you have in this one at the moment, globally? Both the UCITS and the American one.
So globally, we're right around $1 billion. Just over 800 million US. So we're in aggregate. So we're getting there. I mean, this story is new, and it's not everyone has heard this story as much. So we're kind of trying to blaze a trail.
Yeah, that's what I noticed here as well. When I began with the China webinars, and everyone was saying, this is a communist regime, and then you tell them more about it, and they start to like it. And now it's like, what should I do if I want to participate? And then it's good to have such a specialized offering. So Yeah,
I think a big part of that is the research that we see these headlines sometimes, and again, I think it's really about providing that balanced perspective, and Xiaolin and our team and Chef Peters in Amsterdam and our colleagues in London, we want to provide that perspective. Yep. I think one of these misconceptions about China, Jean-Paul, has been that we think of China as a export-driven manufacturing country, but the reality is that GDP, more than just over 50% of that is actually the consumer. It's the service sector. China, a decade ago, was about a third of the GDP came from manufacturing. Today, it's less than 20%. So this growing urban middle class is consuming more. And I think that's something that as investors, we know domestic consumption is a big theme. And it's interesting because, we've had recently Singles Day. This is Alibaba's sales extravaganza. And Alibaba sold, it's reported, up to $70 billion worth of goods during the Singles Day extravaganza. But their arch rival JD.com reported they did over $30 billion worth of goods sold. So again, our perception about China, we think about China's economy is manufacturing iPhones, but really it's become more of a consumer, buyer of iPhones rather than a manufacturer. And again, I think this is part of John Crane's original thesis around, the Chinese government, realizes that domestic consumption makes the Chinese economy less reliant on its trade partners, and so it is a key initiative within China. Now, I think what's different about China, if we look at the next slide, Jean-Paul, is how the China consumes is very different. That in China, in the U.S., my wallet, I have cash, I have credit cards, but in China, this is your wallet, it's your purse. That the adoption of smartphones has been the biggest trend in China over the last 20 years. And China, it's already the largest internet population globally. But what's different is how much the consumption takes place online. The Singles Day in 2020 was 7 times bigger than what Alibaba did on Singles Day. Was 7 times a lot more than 7, probably close to 10 times bigger than, say, Cyber Monday here in the United States. So what's different about China is so much of this consumption takes place on smartphones. Fully 25% of China's consumer goods are purchased online. On that Singles Day, it'll probably be over 90% of those goods sold were done on a smartphone. So it's very interesting that in a lot of ways, China's leapfrogging over this stage of big box retailers, and it's happening online, and it's really happening on smartphones. Mm-hmm. Now, part of that adoption on the next slide has actually been this adoption of technologies has been mobile payments. Mm-hmm. That a key element of why e-commerce is the ability to transact on your phone is through these mobile payments. And China did in 2019 $49 trillion worth of mobile payments. Wow. In the US, I think it was about $500 billion. It's like non-existent here in the US compared to China. And that's where when you go to China, Yeah, you actually have trouble finding merchants who will accept cash.
It's all digital.
It's all digital. It's really, really remarkable. And I think something that we see in the terms of this really new China, this domestic consumption story as it happens online, is it's helping the companies that are invested in this area. So where, if we look at the next slide, if we look at the earnings for these Chinese internet and e-commerce companies, these are predominantly US and Hong Kong listed companies, but you'll see e-commerce companies like Alibaba. So Alibaba recently reported their third quarter calendar year. This is a $800 billion company, and they grew 30%. I mean, you can't find a company as big as Alibaba growing at 30% year over year. But one of their rival, Pinduoduo, they actually just recently reported their earnings. Pinduoduo is, it's an up and coming company. They're kind of like a fast growing. But would you believe in the third quarter of this year, Pinduoduo grew revenue 89%. 89%. So again, the e-commerce companies are really the transmission engines for domestic consumption as it occurs online. Now there's other areas that are part of this segment. So you also have in online gaming and social media, Tencent recently reported earnings. This is a $700 billion company. They grew revenue 29% in the third quarter. $700 billion company grew 29%. It's amazing. Their arch rival in online gaming is a company called NetEase. But you have online education companies. You have online real estate. You have online travel. Obviously that's coming back slowly post-quarantine. So anyway, for us, we see this as the most important part of China's economy is the consumption story, and it's happening online.
But what about this new legislation, Brendan? This new legislation, we had Ant Group coming for 280 billion, and a week later it was 140. So will this not slow the growth of all these companies that you mentioned? So Ant Group is a mobile payment company. It's really a fintech company. It's a very it has almost like a duopoly in mobile payments in China today. And what happened where we thought this company was going to go public, it was going to be the largest IPO ever, was the company had put out its IPO prospectus, very profitable, very fast growing, but the regulators in China had been saying for some time, you call yourself a fintech company because you do all these mobile payments, but you also facilitate loans, that you allow people to borrow money. You match borrowers with banks, that they're kind of a matchmaker. Ant Group was a matchmaker. So they facilitate loan growth, but they don't really take any of the risk of those loans. And the regulator had been saying for some time, we don't like that you just allow people to borrow money, but then you don't bear any of the risks. The banks are heavily regulated because they lend this money. But by calling itself a fintech company, Ant Group wasn't regulated by the bank regulator. And the company put out its IPO prospectus, which was all these great financial statements. But the Chinese regulator was saying, we're going to
regulate you like a bank. And that would have changed the financials for the company. You know, the company had a gross margin of 58%. And if they were going to have to take on some of the risk of the loans that they facilitated by holding some of those loans, the profitability of the company was going to come down. So I know a lot of people say, well, this is just China acting, you know, China regulator interfering with a company. I disagree. I actually think the regulator said, if this company goes public and then these new regulations go into effect, it's going to change the company's profitability very dramatically. So they said, let's just postpone the IPO until these new regulatory and you showed the financial results. Isn't that better for investors? I think so. I think
they were only a little bit late to the game to do it 48 hours in advance. But I understand this, but more in general, this new legislation, I do understand the fintech story, because that's what you see. I see here, for example, on the US side, Amazon, you know, they want to do everything except for the banking part, you know, they do everything around it. So, but the legislation, I think also stocks like Meituan were hurt, at least on the stock exchange, when this new legislation come out. Or do you say, you know, that is, it hurts them less than it does a fintech company like Ant?
Well, I think, you know, recently you've had a little bit of, markets globally have really been driven by growth stocks. Mm-hmm. And I think you're seeing a little bit of these slower growth economic sectors rise. You know, that if we have a coronavirus vaccine, you know, there's the view, you know, life is going to go back to normal. And some of these economic sectors that have been really hurt by the economic consequence of quarantines are going to snap back. Now, we've seen these kind of work from home stocks, these tech companies, these growth companies that you could argue actually benefited from the quarantine, outperform. And so I think some element of, you know, when this news that, like many governments are saying, you know, technology's changed society in a big way. And maybe some of the regulation hasn't kept up with it. And I think, you know, that happened here in the United States. You know, they brought all the technology CEOs and these politicians grilled them. And you know, I think so. I think there's a bigger issue, and I don't think that's unique to China. And what the Chinese government is just saying is, you know, things have moved so fast. Have we really thought about all these changes? And you know, from listening to some of the management calls during these conference calls when the companies talk about their Q3 earnings, this does come up. And you know, what the general view is that you know, what will change in China is if I'm a merchant and I sell on Alibaba, they won't let me sell on JD. That these companies hate each other.
Okay.
And so you have to choose which ecosystem you want to be a part of. If I have Ant Group mobile payments, I can't use that at JD.com.
Ah, okay.
Because
really...
JD is part of 10, so that is what's really going to change is this anti-competitiveness where the companies don't like each other. And so they try to really stop one another from, stop consumers and merchants from using their rivals. That will probably go away. But I don't think that really has a tremendous economic effect on the company.
The underlying story of this middle class growing is by far the most important. Hey, KWEB, that one I have.
Okay. So yeah, I mean, KWEB we listed in the U.S. back in August 1st of 2013. And I think most investors would say, you know, emerging markets, China haven't performed well. But, you know, we've actually been able to beat the S&P 500 over the last, you know, 7.5 years, again, by investing in the growth part of China's economy. And back in November, you know, 2 years ago, Xiaolin and our European team brought KWEB to Europe in a UCITS strategy. And you know, I think, again, it provides that growth element to a investor's portfolio. You know, I think another part of, you know, investors should be thinking about is even part of this growth story is a little bit of a more diversified approach, and ESG investing in China actually provides exposure to these growth segments like we hold in KWEB, but in a broader diversified portfolio. And I know Xiaolin is excited to talk a little bit about her and the team's efforts on bringing ESG investing to China via a UCITS ETF.
Absolutely. I think Jean-Paul is a fan of a China story, and thus far, you know, Brandon shared a great story on how we can access a bit of a core China allocations through KBA, for instance. That's the broader benchmark aware or beta play. The KWEB is offering the consumer power story that play, and the ESG is another story when we thinking of KraneShares UCITS solution to bring to European clients, is another theme that we'd like to offer to the European you know, clients in that format. But you know, I often start sharing China ESG stories, but by sharing a very famous saying. I don't know how many of you may actually know. This is actually over 120 plus years ago, a Chicago businessman. Back then, you could imagine he was admiring the industrialization, and he once said, "Smoke is the incense burning on the altars of the industry. It is beautiful to me. It shows that men are changing merely potential force to nature into articles of comfort for humanities." So, you know, not so long ago, it is in fact, you know, such admirations of smoke per se, you know, industrialization, and in many ways you see that as a pollution is a, you know, a sign of actually in China also, you know, a progress or development, etc. Is all over, you know, it's in China too, and it is kind of like unavoidable, in our opinion, the situation that faced by many nations when their economy was rapidly industrializing or catching up or emerging to catch up with the developed market. It actually took China, Brandon touched base on this briefly at the beginning, it took China about 20 plus years to become the world's second largest economy, and their remarkable achievements does come with a price. But fortunate for China is it can learn from hindsight from all these developed countries. And yep. China usually have a model, you know, to learn how to successfully address, you know, environmental concerns with more of a balanced economics model that China has today. You know, we really think the country is better equipped to tackle the issues better than before. And then I think this is probably about 12 years ago, back in, I think it's July, summertime of 2008, the Ministry of the Environmental Protection was founded in China and really setting the environmental protections at the highest level of the Chinese government. And we see noticeable slowdown output, you know, in the output of industries. And if you remember, I think this was the 19th Party Congress that President Xi Jinping mentioned nature, green environments in his Congress policy speech collectively 41 times. So that's really, when the boss says it, you do it, right? You deliver. Yep. So that's really puts this, you know, ESG related on all corporates and also the state-owned enterprise firmly, focus. This is on top of your agenda. And on this page, we want to share with you how we think about ESG. And often when we discuss ESG, is really get explained at a very high level, but it is important for investors to understand what exactly, the behavior and each of the category that you would count towards to the environment, to the social, to the corporate governance, and the ESG effect. So for example, this varies from companies that implementing, for instance, an initiative to improve energy efficiencies. We see a lot of developments for Alibaba, for instance, with their office in Beijing, is using all the, the new technologies, energies, ways to run the office, and also to certain different developments, like for instance, as simple as your employers providing the right training program for the employees, and then talking about the separate ownership and management that offer a diversified board of the certain company. All these factors are matters for how you can run a long-term and sustainable business. I think, it's also the key steps that to integrate and establish a long-term and sustainable business for investors to consider, to invest. And as you and I know, China is never short of setting ambitious targets over the past years and have proven, they are capable of delivering the goals that they set. Each year they set a 5-year plan every 5 years. So we see, the investments in new energy source increased massively when the initiative of rationalizing the coal production is implemented. And China, in fact, is outpacing the other world leaders and emerging as the new renewable energy powerhouse of the world. The fundamental principles when we were thinking of constructing a China ESG fund is to, one, capture the companies that are the driving force in achieve and surpass ESG goals. And second, are the leaders in continuously meeting and beating the market expectations in setting a very high standard for its peers. So it is important to credit the efforts not only to the private firms, but also to the ones that are state-owned. They call them SOEs. As the reforms continue to push forward, we see that SOEs are even stricter in delivering the ESG requirements, as they set to achieve the government policies. We value the companies regardless, where they are listed. The sectors are broad to represent the broad efforts in the entire economy. So it's really any companies that present great achievements in the E, in the S, in the G. So every factors matters. Not only, but only the leaders will, in our opinion, will continue to drive and, to contribute the growth of implementing the ESG broad initiatives.
So this ETF has an ETF filter on it. Can you tell a little bit more? Do you do the screening yourselves, or do you use a third party? Is it a positive screening or a negative screening? And perhaps to make it tangible, can you name some companies that are part of the other 2 UCITS ETF that are not included here, that have been singled out on this one?
Yeah, absolutely. If you go to the next page, actually tees up better to the next page. When we were thinking of constructing the fund, we evaluate all sorts of different index provider available in the industries, right? With different index providers, with all of them respect to their works, but MSCI comes to our mind purely because they are the most established index provider in assessing ESG related in all the industries in China. Have the longest history. They have 40+ years of such history experience doing so. What we want to achieve is not say, here you go, ESG brought China, take it. We really want a portfolio that credit and reward to the companies in China that are true leaders in different sectors, are driving ESGs in their top agenda, right? Not only government's policies on top, it's the firm themselves that are, trying to drive for such force. Typically, Jean-Paul, you remember, people will say, ESG, if I invest in ESG, I have to compromise my performance, right? It always comes at a price. Most of the time it's compromising with achieving performance. And is that true? It is. If you look at US, for instance, let's use US as an example, MSCI USA and MSCI USA ESG Index. So if we look at just those two indexes, since 2013, that is where the history starts about 7 years ago. The MSCI ESG leader, MSCI ESG, MSCI USA ESG Index has indeed underperformed MSCI USA. So take the US ESG out of the entire USA universe. You did have to go, a little bit of a give up on or trade off on performance for positive social benefits of ESG. But still in China, it's a completely different story. On this page, you see since the inception of the ESG Leader Index in 2013 until last quarter, we have showed a performance chart here that China ESG Leader Index, which is exactly the index of our KESG fund tracked to, has outperformed the broader MSCI China Index over 69%. Right, this is over the entire 7 years of period. And obviously ESG, sometimes ESG investing is inherently of a future looking. There's perhaps no place more focused than planning for the futures in China. I mentioned this every 5 years. Then the nation issues its 5-year plans where the government outlines its vision for the futures and capping carbon emissions, expanding green energy output, and developing high-tech sectors are fundamentals in China's long-term plans. And the internet technology companies within MSCI China ESG, these index leaders, Meituan, you mentioned Meituan, but Meituan Dianping is up 164%. Tencent, Alibaba, we mention those names often, but they up 44 to 50%. WuXi Biologics up 126% this year. These are all the names in this index. But obviously with the healthcare sectors driven by the pandemic, they are boosted the company's commitments to drugs and vaccines developments within these sectors. But if you look specifically at Chinese companies that achieved high scores for their carbon emissions and product carbon footprint reductions within MSCI environment pillar, China's electrical vehicle, for instance, manufacturers are also noticeable, stands out. So for instance, NIO, known as Tesla in China, is 580%. BYD, you guys know the name, is up at 275%. In 2019, China accounted for nearly 50% of all the electrical vehicles sold worldwide. So
yeah, that is BYD. I know from the electric buses, but again, can you mention a number of companies that are excluded in this index that from the popular names? Because I believe Alibaba and Tencent are also part of the KESG, right?
They are.
Which companies aren't? Which ones are excluded?
So these companies are, like you mentioned, Alibaba and Tencent, they are there, but purely because they're ESG scores, right? Not because of other of the part of the business, but their weighting in these broad indices is pretty much, evenly spread. Like heavy industries that are not paying significant contribute to their development in ESGs, like industrial-driven names, and also certain big banks that are contributing to big core production projects are not in the names. I don't want to be too critical, but there are development and improvement in all the names in China. Brennan and I visited Shanghai. This was, I think, last year, October, when we were in Shanghai for our institutional investors conference in Shanghai. We visited Shanghai Stock Exchange, and they disclosed a statistics which shocked me, even a investors myself in China. The lady says today, over 60% of the company that are listed on Shanghai Stock Exchange voluntarily disclose their ESG policies. This number is highest and significant more than I would thought, and also compared to other developing and developed market. You know, is all the companies recognizing, one, the market is opening up on onshore to connect with the international investors. What do I need to do to attract flows to diversify my investor tab from just Chinese retail investors holdings? I need to meet with the standards that are set and recognized by international standards. ESG comes at the top, right? This voluntarily rates is not compulsory. You don't need to disclose if you chose not to. But then the lady says over just short period of time from 2018, so the inclusion happened, to 1920, less than 2 years time, that number stood at 60. Obviously, if they are just a pure, in a very unfortunate and very unfriendly companies, they won't be in this index. And even the names that are in the broader China ESG index will not be in here too. But there will be names you will say, how come that name is there? I'll give you an example where the name is in our index. People always ask us, it's China Construction Bank. By the name, a construction bank is on the ESG leader index and it's the highest number of 7%. Let me tell you why. This is the largest, probably the retail bank worldwide by market cap, China Construction Bank. They do contribute to a lot of the early years when China was building bridges, highways. They're still doing that, but you know, those are the funding projects from this bank by the name, right? It does that. But over the years, what they have been contributing is a lot of green projects. Okay, a lot of projects happening in China, a lot of projects happening elsewhere. And they were the key player, key funding partners themselves in promoting that part of the business and the policy setting for the company to achieve. Remember, Brandon was saying 2050 carbon neutral. They are contributing to all those projects happening in China. They are providing the funding, they issuing the bonds, and they deserve a reward there. One. Second, China also rolling out, this is One Belt, One Road, you heard, Belt and Road initiatives.
Yes, of course.
What they do there is, over the 30+ years, China has been practicing, exercising their ability of building bridges and high-speed railways and such. What are they going to do with the gained top-class skills right now that needed less in China domestically? They are exporting those skills to the neighbors in Asia, in emerging, even in Africa, or some rich Europe, if the Belt and Road routine along the way. And then China Construction Bank will facilitate the new builds along the road. And then what those projects will build upon is hindsight, today's top technology, make them more efficient emission-wise and all these things. So they do by name, don't judge them by name. So they are in our index. I got clients' questions on that. And if you go to the next page, Jean-Paul, I want to show the front page here this is the page that you have the key characteristics of the KESG fund. Obviously, we work with MSCI to only track the leaders because we want those leaders continue to lead the industry's revolution and changes implemented in this broader economy in the ESG factor. Yep, but the fund is really aimed to provide the exposures to the companies that absolutely have the highest rating. But then we only take a large mid cap at the moment in China to this fund. Obviously, you know, ESG scoring has been a start, you know, started as a toolkit to design for investors who want to have a positive impact or mitigate climate change risk on their portfolio. However, beyond aligning with investors' value, these ratings prove to serve, at least in China, as an invaluable filter for identifying high quality growth stocks and then capture those stocks into our fund. Obviously, the past performance is never a guarantee of future returns, but then as you can see, just play with me along the performance if you remember, it's indeed those leaders are leading the performance as well, not just setting the ESG standards, but leading the performances as well. So for the government,
I would say it's a very good strategy because, you know, at least for the region here, because virtually all investors are under-invested in China. So they're looking for excess products, you know, it doesn't go beyond that. So to concentrate on the leaders makes a lot of sense. I think,
Jean-Paul, you hit a great point on access. China has been working very hard to say you have multiple ways to access my market. You can through Connect, you can through different quotas to access the market. Still, it will still present some challenges for small investors to bother to do the paperwork, language differences, time differences, to really do those operations to get access to the local market. But by investing into one single fund, you get an access to the entire opportunity. So that's one of our goals at KraneShares, and also John's vision is KraneShares is offer you the access, one, to capitalize the investment opportunity you see in China, the consumer story, the inclusion story, the ESG story, but also offer you the flexibilities by buying one fund, you get an access to all and deal with all the problems. A little self-promoting here, Jean-Paul.
Yeah, that's good. So here we are with the entire suite. Yeah. There's also a bond fund added to it. But first, if we concentrate on the equity product, so there's 3 UCITS ETFs on China. What do you typically see with customers and prospects? Do people buy 1/3 of each, or how do they choose between these 3?
This is a great question. This makes me remember my past job when I was working at my ex-employer. I was a portfolio manager myself, right? And I'm glad Brendan shared the story. John probably played the same story with me when he's trying to hire me. I was managing $70 billion portfolio, and John met me about 5 years ago. He said, "How much do you have in China?" I said, "0." And he says, "I believe it's an asset class on its own." I was like, I'm buying it, and then I joined KraneShares and joined Brendan. The team shared the same vision that China is an asset class on its own and will be, a significant size within your portfolio. If I may put my, my head back as a portfolio manager today, look at what we said all holistically. Today, like Brendan said, holistically, China's allocation within EM would be over 49, close to 50%. That huge pie would have to be break out, right? Be on its own. If you have a broader EM allocation bucket within your portfolio today, in your benchmark, that 50% should go to China allocation, right? That 50% is China. Out of that 50, we think half is KBA. Why? Because that's a core allocation of China's pure beta play. That's a broader inclusion. It's going to take off. Only 20% inclusion happened. There's still 80% to go. That's your core beta play. I would say either you benchmark aware or benchmark agnostic. You should start from somewhere of your allocation first to make you neutral, then press your view. Additionally, the other 50%, in my opinion, I think Brendan may have different answers, is KWEB and KESG split. Why? Because the consumption story is the world's largest, right? They're going to contribute billions of dollars continuously. With urbanization, we expect 20 million people each year over year to move to city. Those people get better education, better job, better wealth accumulated, and stronger consumption power. That's going to continue for decades. So that is the consumer KWEB play. The other 50 is the ESG. These leaders are driving the standard of the industry. They will get rewarded. They will get even better revenue stream into their different line of business and long-term winners in the broader industry. That's my 2 cents.
Okay, and I'm sure if there are professional clients who consider investing, you can provide them with historical correlations between the indices. I'm convinced they can contact you, right, on that? Yeah.
Yeah. If you go to the next page, Jean-Paul, if we could just go one more. Here it is. You can always, I'm selling Brendan every time without asking Brendan, will be available. Brendan is a American, but is the most knowledgeable guy that I wouldn't have made better than a Chinese person to know China capital market. We always offer Brendan's free time, but if anything, we could be a help in macro, in aligning portfolio, in aligning solutions. Brendan and I will always be available. And you can always send information or questions, any follow-up, obviously, Jean-Paul, like you said, reach out to us.
Well, that's very good. So let's leave the slides here. A very bullish story on China, obviously, because that's your core business. But how do you look at the risks You know, it's fair. I think you said it in the beginning, Brandon, to give a balanced view. There's legislation, there's this government. You know, where do you see, there's this retail investors that I think the China market heard in 2016 when it all dropped. But where do you see, I think the overall story is very positive. I'm a firm believer, but there's also risk. Where do you see risks going forward?
I think, you know, part of the benefit of an exchange traded fund is the diversification, that, you know, that we're not overly dependent on, you know, any single security. And I think, you know, recently, you know, Alibaba, you know, is one of the best managed companies in the world. But you know, it shows the risk that when you buy an individual stock. And so for KWEB and KESG, like, we own Alibaba in those portfolios, but we also own lots of other stocks. And so I think, you know, a lot of the media headlines, you know, are always very focused on the risk around China. No one really talks about the rewards of China. And I think, you know, it's interesting. There's an online gaming company called NetEase. They're Tencent's kind of smaller rival. But when NetEase went public in 2000, June of 2000 on the New York Stock Exchange, or I know it was in the US. But would you believe NetEase has outperformed Amazon over the last 20 years? You know, if you could go back in time and say, if you could buy any stock, what would you buy? I think most people would probably say Amazon, and this,
or Apple, yeah.
Or, I mean, NetEase was up until very recently was beating Apple. Apple kind of surged ahead recently, but if you look at the returns of NetEase, like, who would have thought? You know, it's actually done much better than Microsoft. And so I think, you know, Xiaolin and I have kind of gone all in, and no one should do that. That this is part of a diversified portfolio. But again, I think the risks get a lot of attention, and there are risks. You know, we're not denying that. At the same time, there are rewards, and I think the greatest risk is ignorance. It's people who maybe see some of these headlines and don't look at the data. And we're very data driven, and the data tells a very different picture.
Okay, and yeah, I would like to pick your brain on Taiwan. What's, you know, that there's a lot in play with TSMC, and obviously in China you have SMIC. Chips is what Louis Gav told me, is to say chips is the new oil. There will be a war on chips rather than on oil going forward. What's your take on that development?
Well, I think you know, I have a lot of respect for Gav Cal. You know, we are subscribers to their research because they do provide good insights. I think that the trade war showed how connected, how intertwined the U.S. and Chinese economy are. And, you know, Trump's tariffs, you know, were really a tariff on U.S. attacks on U.S. consumers. And I think under a Biden administration, you know, we're likely going to get a more diplomatic and a more communicative relationship again with China. And so, you know, China is a massive buyer of U.S. technology. And I think, you know, it'd be interesting to see if some of this trade war, tech war dialogue tempers down. You know, Huawei was a company no one had ever even heard of. And all of a sudden it's like a national security threat.
Yeah.
You know, they make, if you can't afford an iPhone or a Samsung, you buy a Huawei phone. And all of a sudden it's like, you know, no one had ever heard of it. And so this is part of Trump, you know, as a distraction. Look over here. You know, as a distraction technique to point the finger at China. And,
okay, excellent, excellent. I think we're well over now. We should leave it here. I like it a lot that the UCITS ETF that you have there, they are listed also in Amsterdam, so easily available. That's a big plus. Thank you so much for your time, and connection details are there. And yeah, good luck with the business going forward. Thanks a lot.
Thank you. Thank you for
Stay safe and healthy.
Yes, you too. Ciao.
Bye.